Given that last summer's COVID-induced demand slump for LNG in Asia, what is your base case scenario for Asian demand this summer, and what would be the biggest risks to the above scenario?
Thank you for having me again, Nasser. It's a great opportunity to speak with you about transitions and changes in the global LNG market that we're seeing today. You're right. We had a very dynamic 2020. When we're moving into summer 2021, we really do see Asian LNG demand picking back up year on year relative to where we were last year. A lot of this is going to be a return to normal demand levels after COVID-induced demand destruction recedes a little bit. Key here is going to be places like Japan, South Korea, and of course China. We have to remember, when we think about gas demand in China, the biggest driver is going to be industrial sector. So as we see economic activity pick up, as we see it continue to momentum forward, that gas demand is going to continue to grow. And that underpins our summer growth forecast. We think Asian demand this summer grows year on year about 9%. That's relative to contraction last year. And this is really holding up our expectations for what we see this summer. Now, of course, there are always risks. We mentioned South Korea, we mentioned Japan. There's a lot of risk there on economic activity and city gas demand, and that puts some downside on our expectations. Outside of Northeast Asia, of course, the growth markets in South and Southeast Asia, India, Pakistan, Bangladesh, a lot of this is based on continued expansion of the gas consuming areas in those countries, and we do see healthy growth, specifically in India. But if production surprises there, domestic production that is, there's downside risk, of course.
Samer, coming out of a harsh cold winter, how big of a stabilizing role in the global LNG markets do you expect from Northwestern Europe to play over the next few months?
Northwest Europe is always going to be the global LNG markets balancer. It has expansive regasification capacity to import LNG. There's third-party access, so anybody can just really buy space to put that gas into the market. There's a liquids forward curve. There's a lot of storage. So to some degree, Europe's always going to be balancing. The question is, how much does it need to balance? And when we look at this summer, the biggest factor that changes the balancing story in Europe is the winter just passed. We saw, supply disruptions, rapid cold weather in Asia really draw all flexible global supply into Asia in January, late December, January, and February, and that allowed Europe to draw down on storages. What does this mean? Why is it important to balancing? Because that storage is the mechanism through which you see Europe balance the global markets. And now that it's empty, we're at the low end of the 5-year range. We're going to see this summer those storages be used to balance the global market. And that really opens the door for full utilization out of the U.S. The real question becomes, as we move into the next cycle of the global LNG market's development, how much do we continue to lean on Northwest Europe, and what does that mean for the swing dance that is peak Asian demand into winter and U.S. utilization changes in the summer?
Samer, on that particular point, how much U.S. LNG supply growth is expected this year, and could market fundamentals this summer necessitate U.S. producers to curtail supply again, as they did last summer?
No, so this is a big year for U.S. LNG. I mean, last year, despite having massive capacity growth to export LNG, prices just did not let that happen. This year, prices are incentivizing full dispatch, at least in the next couple months. And what that means is we expect to see U.S. LNG exports this summer basically double year on year. It's going to be a lot of volume. Now, there are risks here, of course, specifically because the ability for the U.S. to continue exporting at full capacity, that is full fire, through the entire summer is dependent on how long Europe can balance that level of supply. That is how long it takes to fill up European storages. Now, assuming that we have normal demand patterns in Europe, and we don't see downside surprise in Asian demand in Q2, that is, through June, we would expect to see no curtailments out of the U.S. this year. That's full exports all of summer. But if there are any bearish risks in Q2, if we see Asian demand surprise to the downside, we see extra exports from places like Egypt, Russia, Qatar, Malaysia. What we could see in that case is European storages fill up faster than expected. And in that scenario, there is some risk for U.S. shut-ins when we look at the July, August, September period. Really, that August, September period is the risk zone.
Samer, let's talk about your medium-term outlook. Consistently, most outlooks over the last few years painted a weak picture for the LNG market moving into the middle of this decade due to oversupply of under construction and planned big capacity build-outs. But new capacity has taken a plunge in 2020. Is your outlook any different now?
Great question. When we look at the medium-term outlook, we're really looking, through 2026 or so. And the reality about the LNG market is that it's very cyclical because of how long it takes to build new capacity. What I mean by that is projects that we expect to come online in the middle of this decade are effectively already locked in, financed, and under construction. So the period of oversupply in 24, 25, 26 is essentially a sure bet. The question then becomes, when will it actually hit? When will this new supply hit the market, and most critically, at what price? Given what we've seen in COVID, the biggest outcome really is construction delays because of COVID-induced manpower issues, right? We see a year delay in Qatar, we see a year delay in Senegal, a year delay in Mozambique relative to our base case. And this really pushes the oversupply from 24 to 25. Now, when we think about what happens after that, because we're spacing out some of this build out, it really brings into question when the next market opportunity is. And the big factor here has to be Qatar's massive expansion. They're going full-fledged ahead. And with that expansion, we effectively see the next opening, the next need for new supply isn't until 28 or 29 at the earliest. And it really puts a lot of projects into question, specifically those in the U.S., where we don't actually think we're going to see any more greenfield FIDs, at least for the immediate term, because of this degree of oversupply in the middle of the decade.
We will talk a bit later on the Qatari expansion plans, but let's talk first about that huge price squeeze that Northeast Asia saw early this year, with some spot prices soaring to $36 per million BTU due to cold weather and logistical constraints. Do you, Samer, expect such volatility to become a more commonplace in LNG markets in the medium term? Why or why not?
This winter, we really saw a perfect storm of bullish factors. We had outages on the supply side in Qatar, Nigeria, Australia. On top of that, we had the need to draw in marginal supply all the way around the Cape of Good Hope from the US. That's a 30-day journey per cargo. And then on top of that, we had weather hitting, making very cold temperatures and inducing prompt demand. These things together really caused constrained market pricing when it came to spot prices, to JKM prices in January and February. And in reality, all these factors coming together was a 1 in 100 event, right? You had everything occurring all at once, and that caused this massive volatility in the market. Now, what we're not saying is that this can never happen again. What we need to differentiate is what of these factors are endogenous and what are exogenous. That is, which ones are here to stay and which ones really are idiosyncratic. And when we think about the ones that are here to stay, they're important ones. Two that we have to think about. The first one is supply for Asian demand, new Asian demand, is going to have to come from the Atlantic basin. That is the US, that is Qatar, that is Nigeria, because there's just no new production to meet that demand on a net basis in Asia. What that means is that journey times take longer, and thus any squeezes in prompt demand are going to incentivize higher pricing because shipping is more expensive. That's not going to go away, right? So wider spreads, that is, a bigger differential between JKM and maybe European or US gas pricing, we're going to see that every winter. Now, massive swings are unlikely. The one that we saw this time was because of so many factors coming together at the same time. So we have to differentiate what is normal from what's abnormal, what is constrained market pricing. We don't forecast that kind of significant constraint in the near term, but we do think that shipping logistical constraint issues and the need to pull in supply from the Atlantic Basin are going to make it so that in the winters, Asian LNG prices are significantly at a significant premium to global gas prices elsewhere.
Let's talk about Qatar now, Samer. Qatar Petroleum officially announced a final investment decision on its 33 million tons per annum North Field East expansion. S&P Global Platts thinks the new supply will only come online in 2027. The long-run break-even costs of Qatar's NFE LNG into Asia will remain at a very competitive price level, though. But despite this, what are the challenges that Qatar will face in marketing these huge amounts of LNG?
Qatari LNG is one of the most competitive LNG price points in the market, both existing supply and new supply. There is not a question around that effectively, especially given that when you have oil prices above $35, Platts Analytics research shows that Qatari LNG is effectively free, the feed gas for the LNG, because of the liquids production alongside the gas production. Now, putting the price points to the side here for a minute, we do think that Qatari expansion, the NFE expansion, is going to be fully online by 2027. And that's going to bring a lot of new supply, 33 million tons per annum to be exact. Now, when we take into consideration the other volumes that Qatar needs to market from expiring contracts as well as projects in the U.S., we're talking about over 60 million tons by 2027. That's a massive amount of LNG that requires new contracts. That's a challenge for Qatar, but we are seeing Qatar step up to that challenge. We're seeing them do it in a number of ways, right? First, what we start to take shape in 2020, late 2019.
Briefly, Samer.
Was the development of QP trading. QP trading is their arm to do spot sales, and that's going to really allow them to push into the short-term market. Finally, more recently, we've seen a very aggressive and flexible contracting strategies by Qatar Petroleum in the new contracts that they have signed. That is a much lower price point, beating out their competition. Qatar is stepping up to the plate to sign these volumes, and they're really laying down the gauntlet for other projects globally.
Thank you very much, Samer Mosis, for your take on the LNG markets, and thanks for coming on the show. See you soon.
Absolutely.